Okay, like you said, Paul, you got to keep it close.
Right
All right, well, welcome everybody. Glad you could be here tonight. I'm Doug Bennett. I'm the director of the New York Tech Alliance, and just glad to be here with you tonight, and glad to be with Paul, who we've partnered with in the past and on this event. And in a few minutes, Paul will introduce the panel. Before we get started, just want to share a few notes with you. We're recording the event tonight, so for anybody who's not able to be here, we post this on our YouTube channel. And if you want to see this later on or share it with others, you can go to our YouTube channel. YouTube, let's see, well, you can read it over there. It's right in front of me. Sorry. I can put on my glasses and read it there. For anybody who doesn't know about the New York Tech Alliance, we're a nonprofit that is focused on serving the New York tech community in the greater New York area. And our focus is on diversity, equity, and inclusion. And, we're really proud to do that at a time when this is such an issue in our current environment. But that's what we do. If you'd like to learn more about us and what we do, you can go to our website at nighttech.org. Okay. Big shout out to Civic Hall. How many of you are here for the first time? Okay. So Civic Hall is a nonprofit that is focused on primarily tech for civic good. And the Alliance, the Tech Alliance, is a part of Civic Hall. We do three things here. First of all, we occupy floors 2 through 7 of this building. It's about 85,000 square feet. And there's three things that go on. Digital skills training to help people get jobs in the tech industry. Meetings and events that primarily take place on floors 2 and 3. And membership for both individuals and organizations. So tonight, Civic Hall is offering a free trial membership for anybody interested. It's a 1-month free trial. So if it's interesting to you, take a picture of the QR code and remember to plug in NYTA on the promo code section and fill out the application and hit submit. We'd love to have you here. Okay? Izzy, how's my voice back there? Am I coming across? Okay, good. Thumbs up. Very good. All right. I want to give a shout out to our sponsors. These are the companies that help make a lot of things possible here. And a big shout out to Ellis Law Group and Paul. Thank you for sponsoring tonight's event. Tonight also, I want to let you know that Monday is our next event is this coming Monday, May 12th. We've got our meetup going on the second floor. We're focused on disability tech, and we've got 5 great companies that'll be demoing. And for everybody here tonight, we're offering you a free guest pass. So if you'd like to scan the QR code at the bottom of the slide, follow that and complete the registration online, okay? We'd love to see you there. And that's it. With that, I'm going to turn it over to you, Paul. And just remember to pass the mic to everybody. And when we do the Q&A later, we just need to capture your voice so we get it on the recording. So just take a moment to receive the mic to ask your question, okay?
All right. So I think we'll try this, okay? So looking back 2 or 3 years, late 22, early 23, me and my colleagues in our firm were closing venture deals like people eat potato chips. Boom, 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 boom. It was really a robust time. A lot of companies were getting funded, deals were getting done. It was a great time in the tech community. I think everyone in this room, people who are founders, recognize that a lot has changed over the last couple of years. Now, Alan's going to tell us in a little while about the amount of venture capital funding that's still happening But we all know that the real question is how much of it is going to early stage companies and companies that are not the AI superstars. And that's really what we're going to be talking about tonight is, there's money out there. The best companies are getting funded. The question is, how do you make that your company? So we're going to be talking about what are the characteristics that VCs are looking for in selecting a company for funding. We're going to talk about strategies for you to stand out when talking to VCs. We're going to talk about opportunities for hypergrowth, what the market looks like, and hopefully by the end of this evening, you'll have taken away some nuggets that will help position you for your next round of funding. I'm excited to have a really great panel here today to go into this topic. We have Dan Burstein, co-founder of Millennium Technology Value Partners. We have Matt Kaliski, principal of Acronym Venture Capital. And my partner in crime, Alan Wink, managing director of capital markets at EisnerAmper. So we're really, really excited to have such a great panel. It really does so much work in this area. Before we get into our substance, we are going to go down the line, do quick introductions. Again, my name is Paul Ellis. I am a co-founder and a board member here at New York Tech Alliance. I am managing partner of Ellis Law Group. We are a boutique firm, 10 lawyers. We do a lot of work with startup companies, tech and tech-enabled companies, and venture capital funds. We are doing the life cycle of work, so we do financing, but we also do formation, we do equity plans, employment agreements, IP protection, exits, general operations. So the life cycle of issues facing startup companies, as well as for venture capital funds. Our lawyers all come out of top law schools and major law firms, allowing us to give big firm expertise with a more personalized attention and the reasonable cost structure of a boutique. Lately, we've been getting a lot of clients that come to us out of the big firms because they find that our experience in this area, plus a cost structure which is maybe half the rates of the big firms, is a very compelling value proposition. So our clients come to us because they're looking for someone that will handle their legal needs efficiently and cost effectively so they can focus on growing their businesses. Anyway, I love talking to startup founders about the cool things you're doing, so feel free to drop by afterwards and or send me an email, and happy to speak further. With that, I will turn it over to you, Dan.
Thank you, Paul, and thank you all for coming, and thank you to the New York Tech Alliance for having me and having us. I'm Dan Burstein, co-founder of the Millennium Technology Value Partners firm based here in New York, although I personally live in Connecticut. And our firm is a family of funds, and we do a variety of things. We have some deep tech AI-oriented funds within our franchise, and we have some deep value and mid-stage funds that do various other kinds of investing. We probably got our name best known in the period after the so-called dot-com bubble, from which we draw our fund name, Millennium, which was founded right after the turn of the millennium 25 years ago. And when a lot of investors were fleeing the venture capital market after the disaster that was the dot-com era for many investors, although not for us, we began doing, we were among the first to do secondary-oriented liquidity investments, and we got really our name recognition in a lot of ways for making early investments in the shares of what was then Facebook and Twitter and Alibaba and a whole bunch of other name recognition companies when other institutional investors and others in the venture ecosystem didn't want to have anything to do with venture capital anymore after the bubble burst, and indiscriminately started leaving venture capital as an asset class. And we were only too happy to buy up their shares, and moved on from that to all kinds of other reasons why people might want to sell their shares, even in a very valuable company. Founders who were being pushed out by boards, founders whose spouses were divorcing them, and they had to make a settlement with spouses and needed to sell their shares to get some liquidity. People who were leaving companies and wanting to start another company, people who had terminal cancer and wanted to travel around the world. We identified at one point around 2009, 101 reasons why people who had a lot of shares, even in very successful companies, might want to sell some of their shares. And our advice to them was, don't sell us all your shares, because you might still have a big win coming. And we found ways for them to sell us shares, and even the shares they sold us, to protect their upside. Sell us a quarter of your shares, and if there's ever a 5x return, we'll give you 50% of the amount above 5x. So people were generally very happy with the deals they made with us. We figured out loan structures to prevent them from having to pay taxes. And we did all this through our fund, and we became very well known as the trusted liquidity partner to a bunch of companies that really valued our expertise and our resources. And we moved from that. My founding partner and I, when we started the firm, both came from Blackstone, and we had a theory that we could provide structured financial solutions to Wild West venture companies that could use these to figure out complex problems in their capital structures. And that's more or less what we've been doing for the last 25 years, not just secondary, but these venture-backed companies, as the lawyers and accountants here will tell you, frequently backward integrate into having problems beyond just the development of their technology and their products and their team. And so we became a firm here to help companies solve those problems, whether it's personnel problems or capital structure problems. So we do that, but we also have funds that focus more on early stage investing, and they've been able to invest in some of the great names of the AI age, and I'll be happy to talk about that later as we get into the questions.
Hey everyone, my name is Matt Kliski. I am a principal at Acronym Venture Capital. We're an early stage generalist fund, but we focus solely on that weird stage between seed and A. So if you raised a C but not quite an A and you're looking for an extension, maybe there's a cap table problem or something like that, we kind of love getting involved with early people, product, and process, and helping companies kind of professionalize and scale that out to help them raise their next Series A. And I'm based here in New York.
Good evening, everybody. Great to see everybody here tonight. My name's Alan Wink. I'm Managing Director of Capital Markets for Eisner Amper. We're a global accounting and advisory firm. Our headquarters is here in New York City. And first of all, Paul, I just want to thank you on behalf of everyone here tonight for scheduling this on a non-Knicks Celtic game night. So I think you did a great job, seriously. So we are actually a private equity-backed accounting firm. Towerbrook Partners invested in our firm about 5 years ago. So we're in year 5 of their investment right now, and we've grown substantially over that period of time. We've done about 26 combinations with other accounting firms in the last 3 years. We've probably added about 2,500 people to our firm in that period of time. So we're about the 14th largest accounting and advisory firm in the United States today. We have a large tech and life sciences practice. We work with literally thousands of early stage tech companies across the country.
So thank you all, and really excited for this conversation. And I think, Alan, we'll just turn it right over to you to open up and set the stage and talk about the market. Okay.
Yeah. You know, you said,
Is it on?
what?
Press the,
You know, you made a comment in your opening remarks about, what kind of market is it for, the early stage company, the seed or pre-seed company. And I think when you look at the numbers for the first quarter of 25, you kind of feel like it's become a frothy market again. When you look at, over $90 billion of VC money invested here in the United States, there's only 213 invested all of last year. So you kind of get the idea that, maybe we're going back to the 21 timeframe again. But I think when you peel away a couple of layers of the onion, you get a different impression. And, your question about, what kind of market is it for, the pre-seed and seeds, the pre-Series A company, only 4% of the money invested in the first quarter went to first-time founders. So it's actually going to a lot, much larger companies. 6 of the $91 billion invested, over 60% of that was for 10 deals. So it's really skewed towards the upper end of the market. When you look at sort of the exits, the IPO market's still quiet. M&A activity is very quiet. What's interesting about M&A activity with venture-backed companies, 75% of the exits in the first quarter were for companies that raise less than a Series B round. That's amazing when you think about that. If you look at, the IPOs in the first quarter, 56 billion, 40% of that was one deal, CoreWeave. So the IPO market is still really quiet. I think there is some optimism when you look at the value of VC-backed unicorns. It's over $3 trillion of value. So this IPO market has to open up at some time so liquidity can be created for the funds and give some money back to the LPs. AI and machine learning still dominate. 71% of the deals done in the first quarter were AI deals. The interesting thing with all that being said, pre-money valuations are up across every life cycle. So valuations are up. Fundraising is way down, is what you'd expect because of the lack of liquidity and return of capital to LPs. So I think, and how many people in the room here are founders looking for money? So I think you can probably tell us better, but it's still a pretty tough time out there right now. I hate to say that.
Thank you. Dan, this is
Paul, the on button.
the on button is inconveniently placed exactly where you need to place it on. We can.
I want to comment on some of this. So, are we on?
Yes.
On?
No.
So just to give you a little more color while we have the stats up there, one thing is personal observation. Our firm was happy to be a small participant in CoreWeave, which, although it did succeed in pulling off its IPO, there was a lot of, I don't want to say negative, but downward pressure on the price and on the size of the IPO. So the one big venture-backed IPO that dominates Alan's good news chart here, even that one had some negative buzz around it, although it's done well in the aftermarket, and we were pleased to be a small part of it. But there is a crisis in institutional venture capital today. There is no question about that. If you go back to the end of 2024, there was a widespread belief in the business community in general, in the venture capital community in particular, that the election of President Trump was going to lead to just blowing the socks off innovation, venture capital, business, M&A, crypto, the IPO market. It was going to be a boom like we have never seen. AI, business in general, IPOs, deregulation, everything was going to grow. We were going to make America great again. We were going to make business great again. The stock market was going to go wild, which it did for a brief period. I don't think any of the large cap tech people who suddenly went over to the dark side and supported President Trump had any idea at the time that the Trump administration was going to pursue antitrust cases against Google and Meta and other companies with the same passion that the much hated Biden administration and particularly Lina Khan had pursued. I don't think anybody among those mega cap tech companies thought that there was going to be no relenting on opening up the IPO market, which we still find very slow and very molasses-like. And I certainly don't think anyone thought that the tariff policy was going to bring the kind of uncertainty, potential recession, day by day. Who knows what's going to be tariffed next? Who knows, after all this time, we would have one deal with the one trading partner that President Trump calls comprehensive and the British Prime Minister calls an outline, that we would have one deal with the one trading partner that we have a trade surplus with. So why we're putting tariffs on the UK when we already have a trade surplus with them and they have a trade deficit with us, clearly not the biggest problem in the world, but we're apparently, the stock market today treated that as a good sign that we're getting somewhere on getting trade deals, so okay, that's good. The $3 trillion in value that Alan cites here, VC-backed unicorns represent $3 trillion in value. Okay, that's a good thing. These companies have to get public. Okay. On the normalized rate, not last year, where there were hardly any venture-backed IPOs. I think there were 6 venture-backed IPOs. There were more than that in terms of technology IPOs, but there were 6 venture-backed IPOs in 2024. It would take 50 years to get those IPO'd and unlock that $3 trillion in value. Now, obviously, that's not going to happen. It's going to take less time than that. There will be an opening of the IPO window. Some of those companies will be acquired, although not by Meta and Google and Apple, which the government appears to be breaking up rather than allowing the 3 biggest potential acquirers of companies to allow them to acquire more companies, which is the biggest likely source of acquisitions. Of course, they may allow Tesla and Musk to acquire more companies because he's their favorite. But they're not going to allow Google and Meta and Apple, who have the largest cash piles, to acquire some significant portion of $3 trillion worth of companies, and who, by the way, need to acquire to build out their AI capabilities. And a lot of those $3 trillion worth of companies are in the AI space. So if you're a venture investor in AI, which Alan has pointed out, is where a lot of the value is locked up, and you can't get your company public, you want to sell it. But the biggest acquirers of AI companies are hamstrung by the Justice Department and the FTC saying, we don't want to let big tech companies, except maybe Tesla, get bigger. So it's an interesting question. The funds, if they can't get liquidity for their companies and distribute the liquidity back to their investors, can't raise new funds. So the LPs who invest in the venture funds are sitting here saying, sorry, I can't give you new money until you give me back my investment in your fund 8. I can't give you funds for your fund 9 until I get some cash back on fund 7 and fund 6, you know.
I just wanted to know what your thoughts on the normalization process with money coming in from Dubai now and UAE. With that UAE, the normalization process, now that Trump's, forcing that money to come to the U.S.
From UAE in the Middle East?
Yeah, the normalization.
Yeah.
It's like,
Well, I think-
money coming in to help. So we don't.
It was
Okay. I think there's going to be a lot of money flowing from UAE, from Dubai, from Saudi Arabia. They all want to become part of the AI world. I don't want to go on too long here. We have other speakers, but yes, that's a very important question. And we also, in terms of U.S. companies, we're going to have to deal with CFIUS and who can invest in U.S. technology. China wants to invest in these companies, Chinese domestic companies as well as foreign companies, but China's the enemy, so we're not going to let the Chinese invest too much in these companies. We probably will let the Middle Eastern companies, but we've been saying no to some of the UAE companies that want to invest in these advanced security companies and advanced AI companies, US-based. But I think that's going to be a very big part of the future. And other sovereign wealth funds in Europe, the Norwegians, the other Scandinavians, and more as that comes to the fore. Now, just one caution, and then I'm going to pass the microphone. AI is not one thing anymore. It was kind of one thing, 5 years ago. The statistics tell the story that Alan has put up there. You can't have that much money flowing into AI and imagine that it's like, it's all NVIDIA chips or it's all, AI is now the data centers and the power to run the data centers. And every business you can imagine, from medicine to education to novel pharmaceuticals to robotic surgery to everything else. The data centers, which the UAE is investing heavily in, is probably the key link to the whole situation. We're going to have a huge power shortage in the world. Who's going to be powering all these data centers that are so desperately needed? And I think the Middle East is going to be a source of capital as well as the energy for the future.
Dan, it's interesting when you talk about...
When you talk about taking 50 years to absorb that $3 trillion in value, I think the Magnificent Seven tech stocks in the first quarter of the market cap, which is amazing.
All right, so with that setting the stage, and Matt, I'm going to ask you to lead off on this question. So we're clearly in an environment where there is uncertainty and a lack of predictability in terms of what's coming next, and a challenging VC market. So Matt, as a VC, how is the economic and geopolitical uncertainty impacting your decision-making process, and what do you see coming up over the next, few months or years? I know maybe that's a hard question for any of us, but nevertheless, how are you dealing with it on a daily basis?
Not well, but I think we're all trying to figure that out. Honestly, we're evaluating probably 3 or 4 different companies to potentially lead the rounds. And the big question is what's going to happen when X happens or when Y happens? And it's very difficult for us to plan. And we're making 5, 7, 10-year investments, and we don't know what's going to happen tomorrow. So from a industry standpoint, there's obviously the global geopolitical tension. That's kind of one unknown. The other unknown is just the rapid pace of AI and how quickly that's advancing, and it's making a lot of technologies or softwares that we thought were defensible no longer defensible. So it's really changing the paradigm of how investors are thinking and what they're looking to evaluate, because your product and your technology is no longer as defensible as it used to be. So for us, it means, and for people here, shifting to understand, if everything is moving so quickly, can we get comfortable with the fact that the founding team can learn and adapt at a faster scale than their competition? So a lot of what I'm trying to understand now is, what is the founder's ability to adapt and respond? And so how do you contextualize that? If you have industry experience, that's great. But if you don't, how quickly can you learn? And in the limited time that we have to talk to founders and due diligence, what are the things that we look for in founders? And I think at a time like this, the quicker they can get back to me with answers, with additional documentation, additional details, how quickly can they follow up with customers? Those are all little signals that we now have to pick up on, because the longer term is so uncertain that we need to make sure that the teams that we back, if we like the idea, if we like the market, if we like the direction, is how can they be flexible enough to outmaneuver whatever is happening in the world and their competition, because there are so many different companies trying to do the same thing now because of how much easier it is to create a product. So to your question, how we're looking at this, the impact on investors, and investors are taking longer to make decisions because there's just so many unknowns in a way that we didn't have before.
Alan, do you want to speak to that question from your perspective?
I think
It's become even more important, even as an earlier stage company, to be able to show, the possibility, the actuality of real revenues and real customers. And I think if you have that, the investor can then make a determination whether this business could scale or not. But I think the days of walking into whether it's an angel investor or a VC with your, 8-slide PowerPoint presentation and talking about the future with no revenues behind you, I think it's going to be really, really tough to raise money today.
But if I can just add, unless you're very experienced and you have incredible pedigree, then you can raise pre-product, pre-revenue on just a dream and a team. But I think one of the things that we didn't talk about this is, while valuations are going back up, especially at the Series A, the number of Series A financing is collapsing. So you have a ton of companies that are raising early stage pre-seed and seed on, the magic of AI and what to do. But where we sit is actually quite challenging to figure out how durable the revenue is because so many companies are experimenting with AI. So there's a lot of pilots or experimentation, revenue that is actually not quite sticky. And then what we're seeing is there's a lot of churn that's happening even at the early stage. So revenue, yes, but it's how healthy is that revenue?
And I agree with that. I actually am involved with 2 angel groups here in the Northeast, and even at the angel level, they expect to see some level of revenues, even if it's $100,000, some proof that the model can be purchased by someone.
Those are both such interesting observations, Matt. I mean, I think we've always recognized that VCs value team as much as almost, like product is important, market is important, but team is so important. And what you're telling us is that in these days, it is even more important. The product is even more uncertain, the market is even more uncertain, and that makes the strength of the team and the flexibility of the team at an even higher level. And Alan, the notion of looking for revenues at the angel level, that too is a new thing. That is not something that we used to see. Clearly, a very significant development. So, Matt, I'd like to lean into the topic that you opened, which is the characteristics that VCs are looking for now in founders. And maybe Dan, if you can speak to that. I mean, what is it? What do you need to see? And how is what you are, the sort of team you're investing in, how has it changed from what it might have been 3, 4, 5 years ago?
Well, first, I think a lot of VCs are lazy, so they don't actually deeply look into what they're looking for. They're looking for other signals. So I think, I enjoy working with first-time founders that come from the industry. So I have a different viewpoint than what a lot of other people look for, which is based on, what school you went to, which consulting company, and then which startup did you work on, and then how did you kind of spin off to do what you're doing. And I think that's, that's one, not a good business model because all of those founders are expensive. And I don't think it's necessarily an indication of future ability to build a product, especially in this new age. So for me, I believe now, again, because it's easier to launch a product, you need to have earned insight into the problem that you're looking to solve for, and you need to have incredible intuition for the product that you're building. So how can you get that, and how can I understand whether that is something that you have? And for me, again, I lean more into your work experience and kind of those little micro moments of how are you following up? Are you sending me the things proactively? Do I need to chase you to send me things that I'm asking for? Are you providing me with additional context to demonstrate that you know the industry better than I do, which you should as a founder, right? Because if I know of companies or products or services that are in your market and you're supposed to be an expert on it, then I don't have confidence in you and what you're doing. So I like to kind of like allow the founder to build up credibility through the interactions with me by demonstrating their knowledge and by just being very fast in how they're doing things and also being very thoughtful.
I think there's many different kinds of investments and many different kinds of teams. And there was a time in the history of venture capital when, I don't know if people watch late night linear television, but there's a insurance company ad with the guy saying that when you buy insurance, you have to be involved in the 3 Ps, which are price, price, and price, the Colonial Penn. And of course, it's a big misnomer because the price is always $9.99, but he never tells, I'm 80 years old. Can I get a policy from the Colonial Penn? And of course, yes, you can, but you don't know what the death benefit is if you pay $9.99 a month. It's probably like $500 if you're 80 years old and paying $9.99 a month for a life insurance policy. People used to say in venture capital that it's people, people, people. Okay? That's such a cliche today. Okay, what's your definition of people, people, people? Okay, I found a great founder who's really driven and he's or she is really humble and they've failed before, which I rate really highly because failure is important, and this time they're really going to do it. And they were, senior VP of sales or chief revenue officer at this great company, and everybody loved them there. And they have this great vision, and they're going to, run through walls, and everybody thinks they're the best. Okay, come on. What is their vision for this company? And how is it different from 30 other companies that are doing exactly the same thing? And beyond selling it to you, the venture capitalist, who probably, even if you bring in your young people in the venture firm who have technical degrees, you probably don't understand it fully. And even if you make lots of diligence calls, you probably still don't understand how it really works. And, we pride ourselves at my firm on doing 100 calls and meetings with consultants and competitors and market researchers before we make an investment. But even after you do that, we're generalists. We don't understand how the product, a technical product, an AI product, actually works. We didn't look at the code. We didn't see the flaws in the code. We didn't actually compare the code of this product versus another product. So I don't believe it's people. People is an important part of the equation, but it's really, how do you distinguish? How do you know that this isn't just a product? The people are sitting across from you are telling you this is a platform. How do you know it's going to be a platform and not just one piece of a product solution? So these are the questions you have to really dig into. And I don't believe in binary, personally, I don't believe in binary investing where you say, well, as a venture investor, I can afford to lose on this one because I'm going to make 30 investments in the portfolio. And if one or two of them blow up, we just won't give them more money on the next round. And, so what? We'll make our money on the next investment that comes along. I think you have to invest in everyone believing that either it's going to work or you're going to make it work. And these are the right people and the right idea to invest in. So I think it's different today than it used to be.
We can do a little bit of Q&A as we go if there are any questions. Yeah.
I had questions to what you were saying.
Can we get the mic over? Get the mic over. Hold on.
Can you, it's, okay, I think it's.
Close to you.
How long is the how long is the due diligence now compared to, let's say, a couple years ago? Because it sounds like you're really doing a much more thorough diligence process.
Well, admittedly, we don't always have the luxury of doing as much diligence as we would like to. And sometimes we do what we, at our firm, we call access deals, where, we had a chance to do XAI, and we had a week to make a decision, and, we had to believe that we were going to make money on the deal, and so we decided to commit to it. okay, that, we weren't really going to do a lot of deep diligence on that. We were fortunate enough to have the opportunity to do it. And that happens frequently with less well-known names. There was a deal that came in recently. We wrote the term sheet for it. The team told us that they would take a lower valuation from us because they liked us more than the other guys. We had an investment committee meeting. We had to make a quick decision. We made the decision. We said go. And then we never heard from them again. They went with another investor, even though they told us they liked us more. But normally we like to have a month and do those 100 meetings. Now, they're not all sit-down meetings. A lot of them are phone calls. A lot of them are Zoom calls. A lot of them are calling people we know well, who are market researchers or competitors. A lot of them for us are people we know at the big acquirers who would be like, and we asked them, if you saw a company in this area that solved this problem, would it be on your strategic roadmap to acquire this company, assuming they did everything they say they can do, years from now? It's an early stage company now, but if they could solve this particular problem, which has been haunting this industry, would that be something of interest to your strategic plan? And we know the head of strategy at a chip company or an automotive company or at Microsoft or at Toyota or, these kind of people, and we can ask them candidly, not about this company, but in the generic question. And they'll tell us, that's something we would build in-house. We wouldn't acquire a company like that from the outside. Or, yeah, if we saw a company like that and it were less than $1 billion, we'd buy it.
Thank you, Dan. Yeah?
So several, I'm trying to talk.
Oh, we can't.
Several of you have mentioned that now actual reseed revenue is crucial for pre-seed deals, when in fact, obviously it wasn't a long time ago. What level of revenue are you requiring from people? And I only ask this because I had a very shocking meeting in late March with an investor, not here in New York, but on the West Coast, who said that their threshold is 500K of actual received cash, not even contracted ARR, for a pre-seed deal. And I thought that struck me as being awfully high.
So we typically do late seed, so we don't do this early, but I work with a lot of other colleagues and like founder friends. And right now, I think a lot of investors say they are pre-seed when they really are seed, which means they're looking for product and revenue. And I think at this moment, what I'm seeing is if you're trying to raise $2 to $2.5 million in New York, you need to have at least $250,000 of ARR. Obviously, it's different if you're building something that's like more deep tech or AI or like actual technology, you don't need to have revenue. But if it's an application layer or even a consumer application, like they do require about $250,000 up to like $500,000 for a $2 to $3 million seed round.
As you say, those are really seed deals masquerading under the name of pre-seed, or real legit pre-seed deals that are at less than $10 million valuations.
They're rare. They're rare. And I think part of the problem is because a lot of the pre-seed investors that I'm talking to, there are 20, 30 companies that are trying to do the same thing. So no one is like willing to figure out who to invest in, because at that point it's just gambling, right? It's like everyone's willing to pay up and wait to see what is working. So the challenge for entrepreneurs is like, how do you de-risk it to get to that revenue basis where you need to raise that capital? And that's kind of the trap that you face a lot here in New York, where there are more revenue and valuation driven investors, but that is changing. there's a lot more like pre-seed and true like venture now.
As I said before, I'm involved with 2 angel groups here in the Northeast, and I think their minimum revenue threshold is probably $100,000. And they're probably not looking at any deals where the pre-money valuation's in excess of $6 million. But they just want to see some evidence that this product has some legs. So it's not that much money, just want to see some.
I just want to, not discourage anyone in the sense that there are, as Matt pointed out, there are businesses that simply won't have revenues until they raise capital. And that's kind of definitional to the kind of businesses they are. They have to meet certain thresholds of technical development before which they can't generate revenue. And sophisticated angels won't believe that even if they get some consulting service revenues or something like that along the way, that those are real revenues, even if it's impressive that they have some important clients or that they're doing some custom projects and bringing in some dollars. That's not real revenues if you're trying to make a product or sell a subscription service or something like that. So then you have to get people to believe that if they invest in you, you have a realistic revenue model and the revenues will come soon. We're not living in the day and age of raising tens of millions of dollars pre-revenue anymore, for the most part, unless you're a very famous, well-known founder who's done this several times before and can command that kind of relationship with your investors. That's one thing. The other thing is, if you're going to try that route, you better be in an area that, is really hot, which was one of the questions that was raised. People are still raising money for quantum computing and fusion and these areas that investors who've chosen to interest themselves in those areas know are still 10 years away, 15 years away in terms of generating real revenues.
Dan, just one other comment.
Talk about revenues. Another area we should probably just mention briefly is the whole area of government grants. Because a lot of, earlier stage companies, their initial funding is government grants, and are those grants considered revenue? And I think some VCs will say yes, and some VCs will say no. So.
And
No.
they all become revenue. Anyway.
Even on this panel.
Hi, I have a question, and we speak a lot about these founders having to raise revenue and have revenue to get to revenue on their own. My question is, why don't we see a lot of thought leadership helping them understand how to get to revenue? We see so much emphasis on valuations, on your financing, your run rate, but at the end of the day, how many founders really understand what it means to go out and talk to customers, understand the difference between someone who has the pain point versus someone who's actually willing and able to buy? And we don't see a lot of thought leadership from VCs and people like yourself talking about that a lot. And my question is, why not?
I have some hot takes.
Yeah.
Well, most of us don't know how to do that. To be fair, there is a growing community on LinkedIn of bootstrapped founders that are talking about this. But the core premise is we're selling money. And most investors are selling money. So we want to condition everyone to believe in the myth that you need to raise money to be able to build something, right? And then it becomes valuable and we want to give you more money. That's the business model, right? So what we've always been doing and thinking is how do you help founders build an efficient business? And how do you do that in the age of AI, which makes it much more possible, right? And I think there's a growing, and I was having this conversation with a founder yesterday who raised way too much money pre-product, couldn't find product market fit. They had an acquisition, didn't make any money. And now all of his friends are talking about how do we raise the least amount of money to build a product and actually run a business. And I think that's going to be the next evolution of like how founders are approaching it, because to your point, I think it's like, it's very easy to get validation from building a product, but it's much more difficult to actually get someone to pay you for that product that you built, right? And I think there's different investors put value on different things. Like I think getting someone to give you money for the product that you've built is way more challenging and should be way more rewarded than getting money from investors.